Hello guys, welcome to this part 2 of the International Taxation Learning Series. Part 2 and Part 3 of this series is not only useful for the students of the subject but also practically useful to a lot of employees working in multinational corporates who keep on traveling abroad for projects or assignments and are worried about taxation of the salary earned overseas. While traveling overseas for assignments, with all facilities being provided by companies usually fine, what company does not provide in most of these cases is the insurance against taxes. Employees have to pay their taxes out of their pocket and thus reduce their overseas earnings. We've seen in most of the cases employees does not have any idea about how taxation works and hence they have to rely upon whatever taxes are deducted by the employer. However, in part 2 and part 3 of this video series, we are going to enable you to check whether you are paying appropriate taxes on your overseas income and is there any way to save the taxes. You'll remember that in part 1 of this series we discussed that double taxation avoidance agreements provide relief to taxpayer from the double taxation in case of cross-border transactions, and the same holds true for taxation of overseas salary as well. But to avail treaty benefits and determine exact taxes, it is important to decide tax residency of employees belong to which country. Tax residency is determined through local tax laws of a particular country. As per Indian tax laws, the tax residency is generally decided based on the number of days stay in India during a particular year. Now, hold your breath to listen. Because of this, despite you being a citizen of India, spent entire life in India, if you have not stayed in India for a specified number of days in a particular financial year, you may not qualify to be tax resident in India. The conditions of residency as per Indian laws are quite complex, and hence to simplify, let's understand the same through a flowchart. Now, how the tax residency of an employee is determined in India. So the first condition to determine the tax residency is to check whether that employee has stayed in India for more than 182 days. If yes, he straight away becomes a resident in India. But what if no? If the answer to first question is no, then you have to check dual conditions of whether that employee has stayed in India in a particular year for more than 60 days. If yes, and also he stayed in India for more than 365 days in last 4 years, then he becomes resident. But if none of these two conditions are satisfied, he would be a non-resident as per the Indian tax laws. Now the condition doesn't stop here. Even after you become a resident, there is a concept of resident and ordinarily resident and resident but not ordinarily resident. For that, we have to check certain regularity conditions related to your past. So the first condition in this relation is that whether you are a non-resident in 9 out of 10 last years. If answer is no, because you have not moved out of India in past years, then you have to check subsequent conditions whether your stay because of some reason was less than 729 days in last 7 years. If answer to both these questions is no, then you are a resident and ordinarily resident. But if answer to any of these conditions is yes, then you will become a not ordinary resident. Now, what is the context of all this discussion? What is proof from your residential status? That if you are a resident, that is a resident and ordinary resident, then your global income is taxable in India. But in these two green categories where you are a non-resident or a not ordinarily resident, then your income arising outside India is not taxable in India. Now there may be certain situations where a person may be resident in India as well as in the foreign country. Classic example is where an employee goes on an overseas project, say anywhere in or after June. Since you would have stayed in India for 60 days or more in a financial year and 365 days or more in last 4 years, chances are that you will be resident of India as well as of a foreign country subject to the tax laws in such foreign country. In such case, your global income, including the foreign salary, will be taxable in India, and to add to your tax burden, such foreign salary would be taxable even overseas. Now, how to resolve such cases? There are generally tiebreaker rules provided in the GTA. Such rules to be sequentially followed are: where is your permanent home? If you are going on a temporary deputation, you will have permanent home in India and hence you will be resident of India. In such case, your foreign salary would be taxable in India, but liberal rules will apply for taxation of salary overseas depending upon the tax laws in such countries. Most of the cases of dual residency are resolved in this condition itself, but in specific complex situation where employee has residence in both countries, next rule needs to be checked. Next rule is that where your vital interests are situated. What do you mean by vital interest? The example could be your investments. If these are located in both countries, then unfortunately we have to go to the next rule. Next condition is where your habitual abode, that is, where you reside frequently. If you stay in both countries is equal, then next condition would need to be checked. Next condition is of which country you are a national. Now, if your residency is not decided here, then it's too much. But still, if you happen to be national of both countries, then your residency will ultimately be decided by competent authorities of both countries by mutual agreement. This is interesting, isn't it? In the next video, we'll discuss how your taxation would work through practical case studies. So stay tuned with us. If you've liked this video, please don't forget to like this video and subscribe. Thank you.